Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 245 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. Aaron Kramer is back on the show filling in for Matt since he is out this week. So welcome back, Aaron.
Thank you. Happy to be back on here. I don't think we've talked on the podcast for, it seems like forever now.
Yeah, I know. We were just talking about that before we started recording. It seems like it's been years since me and you have been on the show, since Nick fills in a bunch now. But great to have you back, my
Absolutely.
friend.
Excited.
As always, we will kick things off by quickly reviewing the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts and as of the market close on March 27th. S&P 500 index up 3% for the month and 10% for the year. The Dow Jones Industrial Average up 2% for the month and 5.5% for the year. The NASDAQ Composite Index up 1.9% for the month and up 9.2% for the year. The Russell 2000 Small Cap Index up 2.9% for the month and 4.4% for the year. And the Vanguard All World ex-United States ETF up 3% for the month and 4.5% for the year. 3-month Treasury rate at 5.45%. The 2-year Treasury rate at 4.54%. 10-year Treasury rate sitting at 4.2%. So really strong start to this presidential election year, Aaron. I know I have a couple things I want to talk about in a little bit regarding election years, but typically Q1 tends to be pretty weak, and it's been the exact opposite of that.
I know. That's
and
good.
Last week, Matt and I started off the show talking about it's nice to have like an easy start to the year for once, because I feel like we haven't had that in a long time.
It seems like it's been since at least 5 years.
5 years, yeah. I mean,
start.
it really, if you think about it, it really was pre-COVID,
Right.
where you had kind of just this calmness to start the year, and investors can kind of take a sigh of relief and say,
Right.
okay, we don't have, the world isn't falling, and we can kind of just coast here for a little bit. So that's been nice. So
it's nice to see that breadth too. So I mean, everything's pretty much up pretty strongly to start the year.
And it's also been a very long time since we've seen that, right?
Right.
For the longest time, it was the top, 10, 15 names in the S&P 500 that people kept saying were dragging the market higher. And here you have Apple, for example, that's down 10% this year, but the S&P 500 is up 10%.
Right.
So we're starting to see a lot of these smaller companies start to kick it into gear. Whereas, we weren't seeing that even, at the midway point in 2023.
Absolutely.
Which I think is very welcome. So moving on to tweets, articles, and research from the week. As I mentioned before, Aaron, first thing I have was a blog post from Ryan Dietrich on March 6th titled 16 Charts You Need to Know This Election Year. And I really encourage everyone to go check out this article. It will be in our show notes. But just wanted to pull out 3 little bits of information and talk about them with you, Aaron.
Absolutely.
The first thing he says is the best year for stocks is a pre-election year like 2023, while midterm years like 2022 are the worst. Election years gain 7.3% on average, but are higher a very impressive 83.3% of the time. So I know if I have some of my clients listening to this, they're probably like, I've heard you say this a million times already, Mark, because we've gone over this in review sessions. But election years tend to be pretty average. I know there's a lot of fuss about election years. There's a lot of noise in the media that comes along with election years. But if you take that stuff out, Aaron, and just look at the data, election years tend to be pretty average. I mean, since the market's inception, depending on where you want to pick your starting point, the market does anywhere between 7 and 8% per year.
Which is just about average. And surprisingly, election years are up most of the time, 8 out of 10 years. That's great.
So I know that there is a lot of fear mongering when it comes with the election. And yeah, I get some of this stuff is scary, but if we kind of just put our emotions to the side and look at the data, election years actually tend to be pretty good.
Yeah, and I know I've talked with some charts with clients that I meet with, and especially when there's an incumbent that's running, it tends to be even better, right?
Exactly, and leading me perfectly into my next point. He says that stocks gained during an election year the past 10 times when the president was up for re-election.
That's awesome.
And I know there's a certain subject of the population that's going to be like, well, we've never had a president that's been this bad. And President
we're in
Biden,
uncharted territory,
this, that, and the other thing. And trust me, we've had some bad presidents. We've had some great presidents. But I think this data points to, or at least it just tells me, it doesn't really matter who the president is.
It really doesn't. I mean, if you look back the past 100 years, you want to be in the market no matter who's in office, right?
Exactly.
So that's the thing that's what I always try to remind people of is, sure, it could change some legislation and maybe some things around in the U.S., but it's probably not going to change the market,
right? Exactly. And I think that, the best examples of it, we had, Obama was in office for a significant period of time. We had some great years. We had some really poor years. Trump was in office, had some good years, had some poor years, or at least some volatility.
Right.
Biden had some bad years, had some great years. So it's like,
it all evens out.
It all evens out in the end. And the last thing I wanted to point out here, Aaron, was he says breaking down the 4-year presidential cycle by quarters shows the first quarter of an election year usually isn't very strong. However, barring a 7% drop and circuit breakers triggering today in the market, Aaron, we've seen to buck that trend.
Yeah, absolutely.
And some people might be like, well, if it's strong in the first quarter when it usually shouldn't be, does that mean, Q2 and Q3 are going to be poor? And my theory is no, it doesn't have to be like that.
Right.
And one of the interesting things to me, at least by looking at the data, a lot of the times, regardless of the election outcome, regardless if the incumbent wins or the new person that's running wins, regardless if they're a Democrat, regardless if they're a Republican, after the election results are certified, the market tends to run up into year end.
Right.
So, which I think is very opposite of what some people might think, because if you have a president that gets elected that quote unquote isn't very friendly to the economy or the stock market, people think that stocks are going to crash.
Right. Exactly.
And when in reality, you look at the data, regardless of who gets elected, the end of Q4 tends to be pretty strong after the election results.
Yeah. And the only thing that I would add is, there's going to be bouts of volatility every single year, right? So if you look at any year, there's going to be a 5 to 10% sell-off most years, right? So,
and I think we've gone the past 20 weeks or something without even a 2.5% pullback or something like that. So it's coming at some point. We just don't know don't know when, right?
No crystal ball. Right?
No. The second thing I had was a blog post written by Darius Farrow titled 25 Investing Mistakes I Made That You Can Easily Avoid. So just wanted to pull some of these out and talk about a few of them. Number one is investing for retirement too late. He says from age 19 until 29, I thought investing was about making a quick buck. So naturally, I lost money. I didn't grasp the power of compound interest early enough. Time is the investor's best friend. Invest in your retirement as early as possible, which is always now. And I pulled this one out, Aaron, because we do consulting with a publicly traded company, go down to their facilities, meet with all the employees to go over their benefits program, make sure they understand everything. And this is probably the most popular comment, at least I've heard in those meetings from older individuals that are about to retire, is I wish I started sooner, and make sure when you have young guys come in to meet with you, you're pressing that on them.
Absolutely.
And I wanted to see if you've had the same
100%, the same exact thing. And I've met with 19-year-olds and I've met with 75-year-olds. So I've seen the whole range, at those companies. And that's the one thing that I hear from older employees is, I wish I had been more disciplined early. And especially for those 18, 19, 20, 25-year-olds even that I've met with, it's always encouraging them, hey, you're making really good money right now. You don't have a ton of expenses.
Right.
I want you saving 15, 20% of your pay. And if you start now, you can retire at 55.
Yeah, exactly.
Early,
and they're
early.
And the two things that stand out to me there are, number one, they're going to have more power to decide when they want to retire.
Absolutely.
Not have someone like us tell them that they have to keep working until they're 70. And number two, when you start off saving, let's say 20% of your pay, you're going to keep that habit through life. You just don't know any different.
Yeah. If you start early, you don't feel it in the later years because maybe you get cost of living adjustments. So your pay feels like it's, going up over time because it is. But if you just stick with that 20%, retirement's going to be easy for them, honestly.
Exactly. So, good one there. Next one was not creating a financial plan without a roadmap. I always aimlessly invested and traded. A solid financial plan helps guide investment decisions. And it's just kind of like with anything in life, you want to have a plan for where you're going.
Right. You need goals, right?
Exactly. Because if you don't have a plan, things can kind of go off the rails, right? Especially with markets and the emotions that come into market volatility. So not creating a financial plan, I think, is a big mistake if you have the ability and the means to do it. There are a lot of free tools out there on the internet that if you don't want to work with an advisor, technology has been a wonderful thing for this. So not creating a financial plan, wholeheartedly agree with.
Absolutely. I mean, even just at a minimum, doing a 401k growth calculator or a compound savings calculator and saying, hey, my ideal goal is I want to retire at 55 or 60, right? Just playing with those numbers and having a good goal, I think is just something to stick to. And it's probably going to change, like life happens, right? So things are going to be malleable, but just having kind of one goal towards that, I think is much, much better to stick to.
Yeah. And kind of going back to the younger generation, I found that tool extremely helpful with if they're timid or they're like, I don't really want to invest. I want to keep this money. I want to spend this money. But if you show them what their money could be worth in 20 or 30 years and that money is over $1 million, a lot of them are like, oh. Really?
I'm not just throwing money at something hoping it grows, right?
Right,
it's
exactly.
Like showing them that this is what it could be at.
And it doesn't take that much for some of them. It's only, 7% of their pay or 10% of their pay, depending on what they're making. So it doesn't take a lot, but going back to the earlier you start, the more likely you're going to reach your goals and the less you're going to have to save each month.
You're not going to have to save half your paycheck when you're 55.
Exactly.
Because you started at 15, 20% or 10% at 25.
Correct.
Right? So
correct. Next is trying to predict the market. Don't think we need to say anything else on that. We've gone down that road before. Chasing hot stocks. Following the herd often leads to buying high and selling low. Stick to your plan, not the crowd. And I think this is the biggest thing the media gets us into trouble with. And, listening to analysts and so-called experts is, a hedge fund manager could go on CNBC and say, 50% of my portfolio is XYZ, and everybody automatically thinks, hey, I should own a lot of that too.
Yeah.
Whereas, the individual that's watching this person on TV does not have the same risk tolerance, goals and objectives, or capital for that matter.
Leverage.
Yeah, exactly. So, chasing hot stocks usually could work potentially in the short term, kind of like after 2020 when all the internet stocks went nuts.
Right.
But long term, not a great idea.
I would agree. Not a great idea.
Being impatient, he says, trust me, patience pays off big time. Neglecting an emergency fund. So what are your takes on emergency funds, Aaron? I know you're more versed in the planning than I am. Are you still around that typical 3 to 6 months living expenses for most people?
Yeah. So for, a 2-income household, you say it's both spouses work. I'm comfortable with 3 months. If it's a single individual, 6 months living, 6 months of living expenses, I think is a great emergency fund. So that's my general rule of thumb. And, everybody has their number that they want to see in the bank account when they hit their head on the pillow at night. So it's kind of whatever works for you, but definitely having, at least a few months living expenses is very, very important.
Yeah. And that kind of leads right into the next one too, is avoiding risk completely. Look, nothing is risk-free. Some risk is necessary for growth. The key is finding a balance that you're comfortable with. So while you definitely want to have that emergency fund, you have to set limits and say, okay, anything above X amount of dollars in my bank account, I'm going to dedicate to save or invest. you have to take risk if you want to make your money grow.
Absolutely.
And I think this is a common misconception, is that, people think, the market owes me 7% per year without any 10% pullbacks. And it's like, listen, okay, there's just an educational piece that we're missing here that I don't blame people for thinking, because we're not taught this stuff in school, right? But in order to generate those higher rates of return over the long run, we have to take some sort of risk. So I'm not saying when you're 65, you have to be 100% invested in stocks, but there needs to be some sort of risk being taken there.
Absolutely.
If you still need to grow your money to get to where you want to be by retirement, right?
Well, and if you are 65 and want 10% per year, you're going to have to be 100% in stocks. So
exactly.
You can never have your cake and eat it too, unfortunately. So that's, the flip side is usually the biggest mistakes I see a lot of older people have made is they got too conservative too early for way too long. And, they're not keeping up with purchasing power and inflation. That's one of the biggest mistakes I see. And, it's hard once you're out of the market and you're comfortable with getting 1-2% in cash and money markets. It's really difficult to say, hey, let's get this back into the market and risk, a 10%, 15% pullback. So,
that's why I kind of like the idea of, kind of bucketing your investment portfolio to where it's like, okay, my next 2 years of living expenses, it's going to be in all bonds or money market or whatever, just so they're comfortable knowing, hey, I know I have what I need for the next 2 years.
Absolutely.
So let's be a little bit more aggressive with the rest of the money.
And the rest, if the market pulls back, you've got 2+ years to let it
figure
do
it
its
out.
thing.
Yeah, exactly.
I love that.
And last but not least, he says, falling for get-rich-quick schemes. I bought some of those stupid pump-and-dump cryptocurrencies in 2021. Yeah, not smart, and still one of my biggest investing mistakes so far. So I thought that, this article was really good. Encourage people to go look at all 25 mistakes that he listed, but just pulled out some of my favorites.
No, those are great ones. That's awesome.
Last but not least, I was actually saving this one until you were on the podcast, Aaron.
I'm special. Thank
you. Yeah, you're very welcome. Very special in my heart for this one. So it's an article on Bloomberg by Allison Schrager on her opinion why 401ks may be going away. And some of this was from commentary from Kitsis.com. So I wanted to get your opinion on this, Aaron. But she says, why would they go away? To start, these tax benefits for individuals are costly to the government, with the Treasury Department estimating that tax preferences for employer-sponsored retirement plans and IRAs reduced federal income taxes by about $185 billion in 2020.
Okay.
If the government were to remove the tax advantage of workplace retirement plans, Schrager suggests that they might be replaced with employer-sponsored liquid account that would be funded by payroll deductions, but would allow for withdrawals at any time, which would provide savers with more flexibility given the penalty for early 401k withdrawals. Though the absence of a penalty could lead to more savers tapping into their earmarked savings for retirement, reducing the funds available to support them once they do reach retirement age. So what are your thoughts on this? Do you think this is possible? I know I have my thoughts on people tapping accounts without any penalties because they're doing themselves more damage in the long run.
Second bullet point here, I hate. Absolutely hate. So, I think honestly this is unlikely. With the demise of pension plans, going away, I would honestly argue the opposite. 401ks are just going to keep getting more popular and bigger. I think more and more companies are going to start offering them to be competitive. The smaller mom and pop shops are going to have, even if it's just a simple IRA or a smaller, simpler employer plan. I think things like this are probably going to keep getting more popular.
Right. And I could see maybe because employers get a tax benefit for this too, right?
Exactly.
Yeah. Prior to, I think it was the Secure Act 2.0, it allowed for employers to make matching contributions on the Roth side. Because before that, it was all pre-tax contributions. So I could see maybe that going away and forcing employers to make all Roth. So it's interesting. But if the 401k does go away, I think you would have to increase, the IRA contribution limit, right? Because the IRA contribution limit compared to the 401k contribution limit extremely reduced, extremely low.
23,000 versus 7,000 right now.
Yeah.
So that's a big difference. It's not enough to get a lot of people to retirement is the thing.
Right. So I think this has been talked about before. I'm with you. I don't think it's going away anytime soon. I could see some tweaks and adjustments, but for the majority, I don't think 401ks are going away.
I hope not.
Yeah, me too. Because that would throw a wrench in our industry and the way we do things too.
Huge wrench in our industry.
So I'll turn it over to you.
Awesome. So first article I have is from Ben Carlson. It's titled, "Are We Living in the Roaring 20s?" And he posted this on March 26th. So I'm not going to read the full article because it's kind of long, but I just wanted to highlight, a few bullet points on, his kind of commentary on the similarities between the 20s and these 2020s.
Yeah.
So he says what it took to get to the Roaring 20s. How many people at the time would have predicted during the war, pandemic, recession, depression years that the 1920s would have been the most innovative, prosperous periods our country had ever seen? The 1920s ushered in the automobile, airplane, radio, and so on. So there was a massive stock market boom, an explosion of spending by consumers, the likes of which were unrivaled at the time. After the immense pressures of the Great War, many people simply wanted to have fun and spend money. So this is his case for why we might be in the Roaring 20s.
Okay.
Net worth is at an all-time high. The stock market is at all-time highs. Mm-hmm. Housing prices are at all-time highs. Economic activity is at all-time highs. The unemployment rate has been below 4% for more than 2 years. You can even earn 5% on your cash right now in money markets. Now, some people, some of this is simply numbers go up, but there's more to it than that. So, it's not just inflation and things getting, bigger.
Right.
People are spending money like crazy. So, I love that he makes this point here. So, a lot of people, have kind of complained about prices and inflation being higher, but they're still spending just as much money, if not more.
Right.
So he says, look at a massive jump in the retail sales from pre-pandemic levels. Inflation partially explains this, but on a real basis, these numbers are so much higher than the pre-pandemic trend.
Yeah.
Even after accounting for inflation, people are spending way more on food these days. Again, we love to complain about prices at the grocery store, but it hasn't slowed people down at all. He says people are, in fact, eating out more at restaurants these days. He thinks the period of COVID restrictions around eating sparked something in people that made everybody want to go out to eat more than ever before.
Right. And it was kind of like, initially right after a lot of restrictions were lifted, like there was a travel boom, right?
Absolutely.
Because people were so sick of just being in their house. And it was the same thing. There were restrictions on going to restaurants and stuff. So people were like, so sick of cooking my own meals. I need to go out. And that trend, I think, has lasted for longer than people think.
Years. Absolutely. Yeah. So, that was his next point was the travel boom. So you're right on it. So he says the AI boom. So we're right in the midst of that. NVIDIA's market cap has gained nearly 1.7 trillion since the start of 2022.
Kind of crazy.
So, he says, call it a bubble if you want, but the AI revolution is coming regardless of current tech stock valuations. The future will include robots and AI-based personal assistants and tutors for your children and who knows what else. So, I think it's really kind of an interesting kind of mirroring of, the 1920s on all the technology and, all the things that were created versus right now, we're still in a huge tech boom. And then you add in all those, data points for how good things are right now. I think it's kind of possible.
Yeah, I think it is too. I think, based on, headlines and, things that are talked about in the media, everyone seems to think that, the economy is doing really poorly. But all the things you just listed, the economy is not as bad as most people think.
No, not at all.
And the big thing is the consumer spending. Like it has not
strong.
Slowed down at all. Given, we've had the highest inflation that we've had in a very long time, and people are spending without a hitch,
right?
And not even thinking twice about it. So yeah, really good article.
Kind of interesting. Yeah. So I'm curious to see. We'll see. Maybe in 100 years they'll call this the second Roaring 20s.
Right. Yeah. It's going to be fun to look back on this, even just, 10 years down the road, but could very well be this.
All right, next one I have for you is it's a Bloomberg article. It's titled "Goldman Sees Pension Funds Offloading $32 billion of stock Soon," and it's by Jan Patrick Barnett and Michael Miska, if I'm pronouncing their name right, on March 27th. So just wanted to highlight a few things from the article. Again, it's got a good chart in here on kind of rebalancing flows for pension funds. Again, pensions aren't as huge as they used to be. So again, It's not, 32 billion sounds like a lot, but it's not really that much.
In our industry, it's not that
much.
much. Yeah.
So it says, with stocks set to cap another strong quarter, pension funds are likely to sell an estimated 32 billion in equities to rebalance their positions, according to Goldman Sachs Group. That would be the biggest adjustment since June 2023 and rank in the 89th percentile among estimates over the past 3 years, wrote analyst Goldman's FICC and equities team. While projections on pension flows vary widely on Wall Street, it could heap extra pressure on the market when trading volumes are thin around Easter. After the S&P 500 soared almost about 26% since late October, traders have flagged concerns that positioning is stretched and stocks are more vulnerable to short-term profit taking. So there's again that chart in this article that's kind of helpful to see order flows. But what are your takes on that? I mean,
yeah, I think all of this could be coming together kind of at a perfect timing for a perfect storm of a pullback. Like we mentioned earlier in the show, I think the market's been up like 19 of the past 21 or 22 weeks. Typically we get some sort of a 10 to 15% pullback throughout the year. Markets haven't pulled back 2.5% in more than like 100 days.
Right.
We're at the end of the quarter. So what we typically see is there's a lot of large institutional money managers like pension funds rebalancing, selling some things, getting into some other things. Stocks have done unbelievably well since October.
Right.
So it wouldn't surprise me if there is some profit taking and people are reducing their stock exposure in their portfolios to get back in line with their IPS. So this could be, like I said, a perfect storm coming in the next couple of weeks where stocks might experience some weakness. And I think, as we talked about earlier, we have to expect that. And That would actually be healthy for the market. Yeah, and normal for the long term. I would actually probably be more surprised if the market doesn't pull back over the next month or two than if we got to pull back at like 10%.
Got it.
Okay.
So no, I agree with you. I think it's it's probably due for a little bit of a pullback. So the market tends to trade and 2 steps forward, one step back. So I think that's I think we've been in the 2 steps forward for several months now. So 1 step back, wouldn't be the end of the world.
Right. And I don't want people to get discouraged whenever that does happen.
Right.
Because I know, it's human emotion, right?
Absolutely.
You're riding a high, S&P 500's up 10% the first quarter of 2024.
It's crazy.
It's like, you want to continue that, but at some point we're going to be brought down back to earth right now.
Absolutely.
So, interesting piece. Absolutely.
Last one I have for you, a little bit different. So it's another Bloomberg article, so definitely using their data this week. It's titled "Housing Bond Sales Hit 10-Year High as Mortgage Rates Stay Lofty." So I'll read a couple excerpts from this article. So it's basically saying state and local governments borrowed nearly $9 billion for affordable housing so far this year, the most for the period in at least a decade, as buying a home in the U.S. remains expensive. The Michigan State Housing Development Authority recent $425 million bond sale is expected to help more than 2,700 families get lower mortgages, said CFO Jeffrey Sykes. So Rhode Island Housing sold about $125 million of non-taxable muni bonds, and Ski Town Telluride in Colorado borrowed $31.8 million, half of which will be used to build affordable rental housing. So the 57% year-over-year jump in issuance of housing bonds coincides with a period of lower borrowing costs in the muni market. The 10-year yield on the 10-year AAA benchmark is down 1.1% since November 1st, the start of a prominent rally. Mortgage rates, meanwhile, continue to be twice as high as they were in 2021 before the Federal Reserve started raising rates. So while affordable housing has been a priority for state and local governments for years, one of the main drivers of recent debt issuance in the sector has been an eagerness to retain their residents. So, yeah, I think I tend to agree with that last statement there. A lot of these areas, it's pricing people out of the market with, with mortgage rates being so high right now. So, what are your takes on these munis? I think it's kind of interesting.
Yeah, I think it is too. I think and I haven't recently looked at, munis in a while, just because for the longest time, even on a tax equivalent yield, they weren't really worth sniffing for a long time.
Right.
That could be changing, but the housing situation is just really interesting right now because you have house prices at an all-time high.
Right.
You also have home builders, the sector or the industry group, home builders at an all-time high.
Right,
one of the strongest groups over the past year,
because there's no supply.
Which doesn't seem to make much sense because interest rates are the highest they've been, or mortgage rates are the highest they've been in quite some time. And you've had everybody and their mother over the past couple of years saying, we're going to have a housing crash. We're going to have a housing crash.
Absolutely.
And prices just continue to go up, even with interest rates staying elevated. So I think the next 5 to 10 years is going to be really interesting. I do feel for first-time home buyers
Absolutely.
that, it's pretty expensive to get a house right now. So it's a really interesting environment. And obviously there are instruments to, invest in the housing market that is quite intriguing now. But I think there are still some investors, Aaron, that are scarred to touch anything with the housing market from 2008. So I think there's a little bit of that in play there. But I would expect local governments to keep reinvesting in this type of stuff because, that's probably the most expensive thing that people spend their money on each month, especially low income residents, is housing and rent.
Yeah. And really they can't, a lot of these cities can't afford to lose more of their middle class, right? Especially if you're in, like Telluride, which is a resort area, right? You probably don't have a ton of permanent residents, but it's interesting if they can.
Kenzie was just telling me the other night, she was watching some blogger or something, this video that she made, that her family moved from Tennessee to New York City, which I have no idea why, but apparently it's always been their dream. Yeah, it's opposite. Yeah. So family of 5, so mom, dad, 3 kids, moved to New York City, apartment, 1,200 square feet, $5,100 a month.
That's insane.
Which is wild. In Dayton, Ohio, I'll tell you what, that could get you a lot of house in Dayton, Ohio. That's a lot of house. $5,000 a month
in
the Midwest. So, so it's gonna be really interesting to see what happens here with the housing market. But again, kind of like what we talked about earlier, things have expected to slow and they just haven't.
Not at all. That's good. So we'll see.
Well, thanks, Aaron, for coming on and filling in for Matt today.
Absolutely.
Really enjoyed
Happy
chatting
to.
with you. Hopefully we don't wait this long again to do it
on the books soon.
The near future. So yeah, we'll get one on your calendar. But
alrighty,
we're gonna go ahead and bring in Taylor Ledbetter to discuss the financial planning topic of the week. So Taylor is going to talk about types of income that the IRS doesn't tax. So pretty good timing from Taylor on this topic, giving tax day is just about a month away on April 15th this year. So Taylor, let's talk about tax-free income.
Yeah, I thought this was going to be a good topic to go over because we always go over income that is taxed and those implications, but I've never really ran through like a list of what we don't really have to worry about.
Right.
So the article I'm going to be referencing is by Kelly Taylor, and it was on a website called Kiplinger. So the first topic is going to be financial gifts. So basically, if you give somebody cash or stock, or maybe you buy your teen a car, that person is not going to owe any federal income tax on what you're giving them.
Okay.
Now, with the financial gifts, there is a gift tax component. Normally, that doesn't affect too many people. So in 2024, you can gift up to $18,000, and that amount does adjust for inflation every year. But even if you give someone a gift that's more than 18 grand, you still might not owe gift tax on it. You'll have to file a gift tax return, but no tax due right now.
Okay. So essentially, just to recap for people, individuals can give $18,000 to other people, and that limit is based on the individual. So I could give $18,000 to Taylor, I could give $18,000 to Jenna, and $18,000 to Aaron, and I'm still under that gift tax limit exemption, correct?
As many people as you want.
Okay. So that's important for people to know. And then if you do decide to go over that limit, there is a lifetime exemption amount, but that just goes against your lifetime exemption amount. So if I gave you $30,000, then $12,000 of that would go against my lifetime exemption amount for gifting, correct?
Correct.
Without any tax consequences.
Exactly.
Okay.
Yeah, so again, just focusing on the federal income tax, no taxes due on any gifts.
Great.
Next, we have inheritances. So inheriting an investment account or real estate, that in itself doesn't necessarily cause taxable income to somebody. Now, how you use that asset going forward, that could result in income being taxed, but not the inheritance itself.
Yep.
So some examples of assets that could cause some taxes down the line would just be, interest-bearing savings accounts. If you inherit an IRA, there's a 10-year distribution rule, which I know we've gone over that before. Selling property, but again, no tax due once you get that property or the cash.
Right. Yeah, and the nice thing for inheritances right now, and we deal with this a lot with just, taxable investment accounts, for example, is, people get a stepped up basis for things that they inherit. So if someone's parent passes away and they have a taxable investment account worth $500,000 and $250,000 of that is gains, when the kid inherits that money, they could pretty much sell everything at that point in time and owe $0 in taxes. But that is one of the hotly debated topics right now in Congress, is that there's talk of the stepped up basis policy going away. I think it depends on which party controls Congress and who's in the White House, but that is something that's being talked about doing away with the stepped up basis and having the primary owner pay that tax at their death, essentially. So just wanted to throw that out there for people as well.
Yeah, if they got rid of that, that'd be unfortunate.
That would be unfortunate because that's helpful to a lot of people. So anyways, for what that's worth.
Yeah, well, and that applies to, real estate as well, inheriting a home too. So it's a big advantage. The next topic is going to be just life insurance proceeds, which I think that's pretty standard, death benefits that are paid out. You don't have to pay any federal income tax on that. Next, we have annuities. Now, different types of annuities are subject to different tax treatments. But generally speaking, if you fund an annuity with pre-tax dollars, obviously the payments are going to be fully taxable. But if you fund an annuity with post-tax dollars, only the earnings are taxable.
Got it.
So once you start receiving those payments, if it was made with post-tax dollars, not the entire amount you'll owe anything on.
Got it.
The next item is going to be long-term care insurance income. So any payments you receive from long-term care policies are not subject to tax, or any reimbursements from medical expenses are also non-taxable.
Right, which makes sense to me because if, you're you are receiving the benefit of that income, but it's not like you're putting it in your bank account and spending it. It's like you're paying professionals for care, right? So I think, people will be excited to hear that that's falls under tax-free income. And I know that, long-term care policies aren't as popular today as they once were just because of how expensive they are.
They're pricey.
Yeah, they're pricey, but the cost of healthcare just continues to go up and up and up. So that doesn't surprise me. But yeah, huge benefit that income is tax-free because there's a lot of people that are dependent on those policies to pay for their living ability right now.
Right. And, again, if you're paying those premiums are post-tax dollars, so it just makes sense too.
Right.
Disability benefits also are not taxed. Any pension payments from the Department of Veterans Affairs are also going to be tax-free. Next, we have some capital gains and losses. So this is going to apply to just the taxable individual accounts. So when you sell stock in a taxable account, only the growth of that stock is going to be taxed. So you can sell some shares at a loss and some at a gain, but they actually net against each other.
Right. Which is really helpful, especially from, for what I do for the firm. That's helpful because I can help manage tax liabilities, as we get into October and November, close to the end of the year. I can look at that stuff and look what we're still holding in the account. And if, we have a gain of, let's say, $10,000 and the client's like, hey, I really want the max gain this year to be $3,000, then hopefully I can look and sell something at a loss to get that net gain down to $3,000. So there is some flexibility and leeway with that, which is really nice. So the offsetting gains and losses, very helpful, at least for what I do for day to day.
Yeah, and it's nice that you're not taxed on the entire withdrawal.
Right.
Like an IRA would
Correct.
be.
Correct. Yeah. And your capital gains tax, for those that might be new to investing, your capital gains rate is always going to be lower than your ordinary income tax rate. And as a reminder, to get that preferred lower tax rate for capital gains, just have to hold the investment for longer than a year.
Correct.
Yeah.
Yeah, and those rates are 0%, 15, and 20.
Correct.
But most people fall in the 15% bracket.
Yep.
The next item is going to be Roth account income, but I think we're all very familiar. That's going to be tax-free, but just wanted to throw that one in there.
Again, something that makes sense. It's funded with after-tax money, should come out tax-free, right?
Correct, yeah. And then the last item is just going to be alimony or child support payments. But the alimony, that's only... it's not deductible and it's not taxed if a divorce was finalized on or after January 1st of 2019.
Okay.
So anything before that was finalized would be taxable.
Taxable. Okay. So that's something to note. It's that January 1st of 2019. Any alimony received after that, not taxable. Before that is taxable.
Correct. Yeah.
Okay. Great.
So yeah, I think those were the main ones just from the article. I'm sure there's a lot more items that are tax-free, but I think these are the items that most people deal with.
Yeah, definitely the most common, I would say. So, well, thanks, Taylor, for providing us with some of that education on tax-free income. I know we spent a lot of time talking about taxable income, so a little bit of a change up there, but we're going to leave it there for the week and just want to thank everybody for listening to episode number 245 of the Independent Advisors Podcast. And we will be back with you next week for episode 246.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.